The consequence of this is that near-term inflationary pressures have intensified significantly. CPI inflation is now expected to peak at just over 13% in Q4 of this year and to remain at very elevated levels throughout much of 2023. The bulk of that further increase reflects higher wholesale prices feeding through to retail energy prices, with a further large rise in the Ofgem price gap projected in October. And I should stress that our forecast and our projections take into account the new method announced by Ofgem this morning. So you can see in the next chart the direct impact of energy prices on CPI inflation in our recent forecasts and the extent of the latest upward revisions, obviously the green line. I'll come back to the dashed green line later because that shows an alternative projection which uses the full futures curve rather than the fixing of the line. But you can see obviously very clearly what's gone on in recent forecasts. And I would emphasise also, I use very deliberately the word direct impact of energy. This, of course, is not the total impact of energy. This is the direct impact of energy. Now, this rise in energy prices has exacerbated the fall in real incomes and so led to another significant deterioration in the outlook for activity in the UK and in the rest of Europe. GDP growth in the UK has slowed and the economy is now forecast to enter recession later this year. As illustrated by the white line in this chart is showing what we're projecting, and I'm using the baseline projection here with the fixed line of energy prices, and comparing it with past recessions. So the white line shows that the projected peak to trough fall in output of 2.25% would be similar to that experienced in the early 1990s recession, which is shown in green, if you can see it, although less than the global financial crisis, which is shown in pink. Now, in marked contrast to these previous episodes, this predominantly reflects the adverse impact of the very sharp rise in global energy and tradable goods prices on UK real income and spending. And as shown in the fan chart here for inflation, these developments have further accentuated the extent to which, in the MPC's baseline projection, UK CPI inflation is well above the 2% target over the first 18 months, but well below the target in 3 years' time. CPI inflation is projected to fall back somewhat from its peak to 9.5% in a year's time, as rising domestic pressures are outweighed by the assumed stabilisation of global energy prices and falls in tradable goods prices. And inflation then falls sharply to the 2% target in 2 years' time, as external influences continue to dissipate and domestic factors also fade. And then it falls well below the target in 3 years' time, reflecting a further weakening in domestic pressures. But going back to my introductory remark, the uncertainty around the outlook is exceptionally high, especially for energy prices. Under our standard conditioning assumption, energy prices would be extremely high by historical standards throughout the whole of the 3-year forecast period, and that's the effect of fixing the price. Therefore, as in recent reports, we've also set out an alternative projection in which energy prices follow their downward sloping futures curves over the forecast period, although they're still above their pre-pandemic levels throughout. And you can see that in this chart. Now, as shown in the green to blue line in this chart, under this assumption, the lower contribution from energy prices implies CPI inflation of around 1 percentage point below the 2% target at the 2-year point, and even further below the target at year 3. This would result in a smaller fall in households' real incomes and spending, and GDP would be somewhat higher than in the baseline projection. And you can see that here by looking at the green line that has been put on, comparing it to the white line. The economy is still projected to experience a recession, but it's a less deep one. The difference between these forecasts demonstrates the sensitivity of the outlook for inflation to swings in energy prices, because that's really the only thing that changes here. The Russian shock is now the largest contributor to UK inflation by some way. There is an economic cost to the war, but I have to be clear, it will not deflect us from setting monetary policy to bring inflation back to the 2% target. Now, though responsible for much less of the rise in headline inflation, domestic inflationary pressures have also remained strong. Firms generally report that they expect to increase their selling prices markedly, reflecting the sharp rise in their costs. The labour market remains tight, with the unemployment rate at 3.8% in the 3 months to May and vacancies at historical high levels. The tightness of the labour market partly reflects the fall in the labour force since the start of the pandemic, which is in part due to the large rise in economic inactivity, shown by the orange bars in this chart. As a result, and consistent with the latest agent survey, underlying nominal wage growth is expected to pick up further. Domestic pressures on CPI inflation are nevertheless expected to dissipate thereafter. Although the labour market may loosen only slowly in response to falling demand, unemployment is expected to rise from next year. And with monetary policy acting to ensure that longer-term inflation expectations are anchored at the 2% target, wage pressures are assumed to adjust down quickly as inflation itself falls back. There is, however, a risk that domestic price setting proves more persistent than in the MPC's baseline projection. And with that in mind, the MPR also contains a scenario in which firms are able to pass on the increases in their labour costs to their prices to a greater extent than normal. As shown in the purple line in this chart, under this scenario, CPI inflation is even further above the inflation target at year 2, but unchanged and still below target at year 3. So let me turn to the MPC's decision. The mix of high near-term inflation and weak activity leading up to a recession is a challenging backdrop for monetary policy. Monetary policy must be set taking into account the scale of the shock to real income while keeping our focus on inflation and inflation expectations. Returning inflation to the 2% target remains our absolute priority. There are no ifs or buts about that. At this meeting, the committee voted to increase bank rate by 0.5 percentage points to 1.75%. The committee judged that a more forceful policy action was justified at this meeting, as there have been some indications that inflationary pressures are becoming more persistent and broadening to more domestically driven sectors. Companies are finding it easier to increase prices, and the labour market remains tight. In such an environment, there is a risk that the further jump in energy prices and the higher and more protracted path for CPI inflation over the next 18 months will lead to more enduring domestic price and wage pressures, which would be inconsistent with inflation returning to the 2% target. Overall, a faster pace of policy tightening at this meeting will help to bring inflation back to the 2% target sustainably in the medium term, and to reduce the risks of a more extended and costly tightening cycle later. Looking ahead, that does not mean we are now moving to a predetermined path of raising bank rate by 50 basis points per meeting, or indeed any other number for that matter. Policy is not on a preset path, and what we do this time does not tell you what we're going to do next time. All options are on the table for our September meeting and beyond that. The MPC will take the necessary action to return inflation to the 2% target sustainably in the medium term, in line with its remit. The scale, pace and timing of any further changes in bank rate will reflect the committee's assessment of the economic outlook and inflationary pressures. The committee will be particularly alert to indications of more persistent inflationary pressures and will, if necessary, act forcefully in response. I recognise the significant impact this will have and how difficult the cost of living challenge will continue to be for many people in the United Kingdom. Inflation hits the least well-off hardest. But if we don't act to prevent inflation becoming persistent, the consequences later will be worse, and that will require larger increases in interest rates. At this meeting, the MPC also provided an update on its strategy for beginning to sell the gilts held in our asset purchase facility portfolio. The MPC is provisionally minded to commence gilt sales shortly after its September policy meeting, subject to economic and market conditions being judged appropriate and to a confirmatory vote, therefore, at that meeting. Were it to proceed, the committee judged that over the first 12 months of a sales programme, a reduction in the stock of purchase gilts held in the APF of around £80 billion was likely to be appropriate. Given maturing gilts, this would imply a sales programme of around £10 billion per quarter. The planned details of the proposed programme are set out in a market notice released alongside the MPR. So to conclude, let me reiterate that our job is to hit the inflation target, and in the current circumstances to return inflation to target. To be clear, there are no ifs or buts in our commitment to the 2% inflation target. That's our job and that's what we will do. Thank you.
Thanks very much. And now for questions, if you wouldn't mind identifying yourselves and your organisations, and please do speak up and speak directly into the microphone. It's sometimes hard for us to hear. Try and stick to one question first, if that's okay, and then we'll come around again. Joel, can we start with you?
Joel Hills, ITV News. Goodness, where to start? If Liz Truss becomes Prime Minister and implements a package of immediate tax cuts worth £30 billion, will it mean, Governor, that interest rates will have to rise faster and further than they otherwise would? And connected to that, Liz Truss has also been explicitly critical of the bank. It's accused the bank of failing to grip spiralling prices. Do you accept that criticism? And would a different mandate have helped you keep prices stable?
Well, can I be very clear, Joel, on 2 points? One is that it is, of course, it's not for the Bank of England to get involved in the leadership election that's taking place for the leader of the Conservative Party, the next Prime Minister. We're not going to comment on that. Secondly, as I said earlier, we condition on the fiscal policy that is announced. I look forward to working with whoever the next Prime Minister is, and I'm sure there will be a budget and fiscal policy will be announced, but at this stage I'm not going to go any further than that in commenting on what might or might not happen.
So I had Lucy now.
Hi, Lucy White from the Daily Mail. Going back to Joel's question, obviously Liz Truss has spoken about wanting to alter the Bank of England's mandate. Do you think there is room for a change, and would you welcome any suggestions? And also, obviously, we're looking at a pretty dire picture for households, income falling for the next 2 years, the largest amount on record. In plain speaking terms, how bad does this look for the UK? I mean, obviously, the OBR's projections for the public finances over the long term were pretty bad already. If the next Prime Minister does introduce, further support packages for households, how bad is it going to get?
Well, again, I'm going to, as I said to Joel, I'm not going to comment on anything that is being said by the candidates to be leader of the Conservative Party. I'll say 2 things. One, just to remind what the mandate of the Bank of England is in respect of monetary policy, and that is that the objective set out in statute, it was set out in 1997, is price stability, and that each year the government, in the form of the Chancellor, informs us what price stability, and I'll use the language of the Act, is taken to be. In other words, that the government sets the target. And it's important to make that point because that's a somewhat different structure to many other countries. Now, I'm not saying that in any judgmental sense. That's what it is. I think the great virtue of our system, it is very clear what the target is. But I also make the point that the structure was set up with a very clear mandate of price stability, but there is scope, obviously, and the mandate has, the target has been changed once over the lifetime of the MPC with the change of definition of CPI. There have also been reviews from time to time. Now, on the second question, I'm not going to comment on fiscal policy. All I would emphasise in terms of the situation, just to reinforce the remarks I made, is that the consequences of the actions that have followed and emanate from Russia are obviously serious, as you could tell from the remarks I made and our decision and the MPR. Dave, did you want to come?
Can I just give a bit more detail on there has been a previous review of the monetary policy framework. It was carried out by the coalition government in 2013. I mean, the only other point that I'd mention is that if it's just been 25 years since the MPC was established. So if you take the average CPI inflation rate, bearing in mind, as Andrew just said, that CPI became the target in 2003, but take the average CPI inflation rate from May 1997 to April 2022, it's averaged almost exactly 2%, which is the inflation target.
Thanks. I've got Maureen and then Paul.
Hello, Mehreen Khan from The Times over here. Governor, you've spoken for the last few months about the need to tread a narrow path between managing inflation and growth. Do these forecasts show that actually you will abandon that narrow path and you will have to tighten monetary policy in the face of a sharply shrinking economy? And when was the last time the bank has really been put into that position? Thank you.
Sorry, I didn't catch the last part of it. Sorry.
What are the political pressures that come with having to tighten monetary policy in the face of a severely contracting economy?
Well, I'll tell you the rest. I'm sure Ben will want to come in actually on this. And can I say that one of the great strengths of being an independent central bank is that actually the political pressures have been very well managed throughout the life of the MPC, in my view, and obviously we've had many governments throughout that life. And that is the best way to manage it, in my view. So no, I don't really want to put emphasis on political pressures because I think one of the great virtues of our system is that the Bank of England takes these decisions independently, respecting, of course, the importance of the remit. I'll bring Ben in, but I just want to say on the narrow path, no, I don't think the narrow path analogy has been abandoned at all. I think, if anything, this illustrates, and what we've seen happen since we were last sitting here in the beginning of May, when I know we also talked about the narrow path is, I mean, I don't know whether the analogy is right to say it's got narrower, it's got the slopes on either side have got steeper. I'm not going to particularly speculate on what the right analogy is at this point. But the general, in a sense, framework of analysis of the narrow path is I think, as relevant today as it was then. And I would, by the way, add that I think it's an analogy that's not unique to us. It's used by a number of other central banks as well, who are facing somewhat similar situations. Ben, did you want to?
Yes, they certainly are. I think what is true of the current situation, regardless of that particular analogy, is that we are facing and have for some time been facing these ever-increasing trade-off inducing shocks, to use the slightly formal terminology of the MPC. They are intrinsically shocks which in the near term push up inflation, but also weaken growth. And that combination is unavoidable. It's one that you see throughout the world, certainly this year. We already had those shocks occurring last year as a result of the pandemic. So in non-energy and core goods prices, it feels like a long time ago now, in 2021 we experienced very steep increases, and most of those we import. So qualitatively they had a similar effect. They reduced real incomes even as they pushed up near-term inflation. The scale of the shocks induced by the war and the restrictions of gas supplies have been even steeper. And to give you an idea you asked about history, quite how big they are, it's worth comparing the effects on households' utility bills during the current episode with the 1970s, which was another period in which energy prices went up steeply. So over the worst 2-year period of the 70s, which I think was between the first quarters of 1974 and 76, the share of income going on household utility bills rose by, I think, 0.7 percentage points. So it absorbed that much of real income growth over that period. Between the first quarters of 2021 and 2023, we think that number will be pretty much 3.5 percentage points. There's around 5 times as big. So that is the scale of just the energy price shock. And on top of that, you have what happened as a result of the pandemic last year and other effects of the war, for example, on wholesale traded food prices. Sticking with and picking up slightly on what we heard a moment ago, about monetary policy, it's our job navigating that trade-off absolutely to ensure that these shocks, as enormous as they are, do not persist via more domestic inflationary pressure longer than they should. They will regrettably be with us for a while, looking at the path of energy prices, but we will make sure that they are not there in the inflation rate in 2-3 years' time, and we'll do whatever is necessary to ensure that's the case. And that will be one big difference between this shock, much larger though it is, and what happened in historical episodes, in particular the 70s and 80s.
Thanks. I've got Paul, then August, then Jemana.
Paul Kelso, Sky News. Governor, you talk about a great deal of uncertainty in your models, particularly around energy prices, but are there any scenarios you've looked at that are not catastrophic for the least well-off in society and pretty devastating even for average earners in the next couple of years?
Well, you make a very important point, Paul, and we've talked about this in the past, but it's important to re-emphasise it, that inflation that is concentrated amongst what we might call the essentials in consumption baskets, obviously of which energy is a very important part, as food is another important part of that, hits those who are least well off and have lowest incomes the hardest. And you can see this by looking at the different consumption baskets across deciles of household income in the household survey. So we're very conscious of this, and I said in my opening remarks, this is a very uncomfortable situation to be in. We're very aware of the impact it has, therefore, on those who are least well off. What I would emphasise or re-emphasise is a point I made in my opening remarks, and it's this. If we don't bring inflation back to target, bearing in mind this huge scale of the energy shock we're seeing, if we don't bring it back to target, and if we get these so-called second-round effects entering in, it's going to get worse. And it will get worse precisely, I'm afraid, for those who are least well off in society. So while I have huge sympathy and huge understanding for those who are struggling most with this, and I know that they will feel, well, why have you raised interest rates today? Doesn't that make it worse from that perspective in terms of consumption? I'm afraid my answer to that is it doesn't, because I'm afraid the alternative is even worse in terms of persistent inflation.
August, then Jemana.
Hello. So in this latest forecast, inflation is set to peak at 13.3% in October, and that's based on a prediction that the price cap will rise by about 3,450. But the latest price cap predictions has the cap at nearly 3,950 by January. Do you feel there's a risk that inflation will peak above that October forecast at any point next year?
Sorry, inflation will peak
above the 13.3% you've predicted in October at any point next year?
Well, I mean, our view on, as we've said in the report, is that we think, on the basis of what Ofgem have told us, that the price cap setting for October will be around £3,500. Obviously, beyond that, and by the way, I mean, as you know, I'm sure you know, the methodology that Ofgem have adopted means that the window is not closed yet, otherwise it would have been under the previous methodology. So there's an element of sort of still to be determined, but it's not, obviously not a very large element, but there is. I think beyond that, of course, it becomes less easy to predict because it depends on movements in future price rises. And we've seen from the charts they're moving around a lot at the moment, so it'll be harder to predict. I don't know whether Congress want to come in.
I mean, we set out in quite a lot of detail in the monetary policy report, the risks around that inflation projection. There is, we do have a skew on our inflation projection, an upside skew in the first year which relates directly to the calculation of CPI, because that gets reweighted every year to take account of the consumption basket. And then more qualitatively, we flag the risks
as Andrew has said, were inflation to be more persistent than we are now assuming, then that would give you further upside risks. But overall, actually, we think the risks to inflation are balanced after year one, so we don't have a skew in our forecasts after year one. I think that's right.
There is a bit of, there is another downside, potential downside risk, which is dependent on how the ONS treats the already announced elements of the government support package. So there are risks both ways on energy, I would say.
Yeah. Thanks. Jemana, then Larry.
Jemana Versace from CNBC. I have a question about the term act forcefully. You've kept it in the monetary policy statement today, and it was in there in June and translated today to a 50 basis points hike. My question is about what new information you would need to see to opt for another 50 basis points hike in September.
Well, let me be clear that we make policy meeting by meeting. We will see what information obviously comes in between now and the September meeting, and of course information will come in. It's very important to my mind that we move, and have moved, from what I would call a system of more sort of predictive forward guidance to a framework that is not predictive. It's designed to convey a sense as to the framework within which we make decisions. And so it's very important that the act forcefully language is still there, because the reason is that if we see evidence that we think justifies that, then I think it's important that people understand that's what we would do. If you ask me the question, which I think you were sort of moving to, which is, what are you particularly looking at the moment? Well, I think I would, as well as pointing obviously to what's going on in the external environment, I would go back to the points I made in the sort of latter part of my remarks, which we pick up quite extensively, not only from the surveys, but also I would say, all three of us go around the country talking to businesses, and we do a lot of that notwithstanding the evidence that there is a slowing demand going on in the economy, and of course notwithstanding the forecast that we have, businesses at the moment, as our agents tell us, still feel that they can set prices to recover the increase in costs, and that they're not meeting a lot of resistance on that. So that's an important part of the the diagnosis and the sort of the evidence assessment that we do and will continue to do. I mean, it has I emphasise it because it has a high profile at the moment and needs to have a high profile at the moment because, of course, it goes directly to this question of persistence.
Thanks. I've got quite a lot on the list, but don't worry, we will get to you. Can I have Larry and then Faisal, please?
Larry Elliott of The Guardian. A year ago, you were forecasting inflation would peak at 4%. Now you're predicting it will peak at 13.3%. You say some of that higher inflationary pressure is becoming embedded in the economy, and that's why you're being forced to raise rates by 50 basis points rather than 25 basis points. Your critics say that having been asleep at the wheel, the bank is now slamming on the brakes at precisely the wrong time. They have a point, don't they?
No, I don't think they do, but it's a point that obviously needs to be responded to. So as I said at the Mansion House recently, we've been hit, or the world economy has been hit by very big shocks. And for the UK, that means very big external shocks. Moreover, there have been no what I would call air gaps between these shocks. So if you think about the COVID supply chain shock, which we now begin to see evidence in terms of traded goods prices of it beginning to come off. That has been replaced by this, this huge shock that we're receiving in terms of energy prices, and obviously emanating from the actions that Russia is taking. And I think it has to be clear that the Bank of England cannot, forecast that. I don't know anybody who reasonably can say they could have forecast a Ukrainian war a year ago. So that is a very important rebuttal to the point, Larry. The second thing I would say is that the point on the Bank of England taking action sometimes then goes to the question of quantitative easing. did we do too much during the COVID crisis? And my response to that is as follows. I think if to sustain that argument, you really have to make the argument that domestic demand in the UK has risen, substantially as we came out of COVID. And that is simply just not the case. I mean, what we've had in the UK is a situation where GDP, has just about got above its pre-COVID level, but only just. And of course, if you take the forecast that we're presenting today, that is not going to be sustained. And what has actually happened is that we've had a series of supply shocks, going back to my point about global shocks. So, to sum up, I don't accept that argument, I'm afraid.
Do you mind, Andrew, if I
you want to come in back?
Yeah, supplement with a couple of numbers. You mentioned the peak, the forecast peak a year ago, and what it is today. And in his opening remarks, the governor pointed out, A, that between those two times, the wholesale price of gas, the one that forward price for the end of this year, has gone up sevenfold, and that just the direct effects of that increase in energy prices would be 6.5 percentage points on inflation. Chuck in the direct effects, and you're getting to the vast majority of the increase in the forecast. Earlier, even that 4%, a lot of it was due to external shocks of the kind I was describing earlier that happened to be non-energy due to the pandemic. It's a marginal thing now relative to what we've seen in energy prices. But it is actually the case, as we thought it would be a year ago, that some of those increases in core goods prices are now beginning to stabilize or even to reverse. And there's a bit of that in the report. And that's why at that time, and indeed throughout the last year, we were not responding directly to these external shocks, enormous as though they've been, because what we're interested in is more, will they persist? Will they be there by the time a policy decision gets taken now has a significant bearing on inflation? That's the relevant thing. And that's what we've been responding to, the signs of more domestically driven inflation. Now, they're much smaller, they're far smaller than those headline rates, but that's what we're responding to because that's what we want to ensure doesn't remain in inflation in a year, 2 years' time. In order to have kept inflation, let's suppose that we'd had this extraordinary foresight to see the continuing pandemic restrictions on supply in Asia throughout last year, more importantly to foresee Russia's invasion of Ukraine. And then ask what would have been necessary to have done, possessed of that foresight. Let's say we'd seen everything, all of this at the tail end of 2020, which is, given the lags, what we'd needed to have had, that foresight, in order to have hit the inflation target right now and offset all the effects of that on inflation right now. Interest rates, in order to offset that, would certainly have been, miles into double-digit territory, and we would have had a far bigger recession even than the one we're forecasting now, and nominal income growth would have to have been steeply negative. So that's what would have been required. Now, after the event, you can say, well, you should have done X, Y, and Z. I'm merely saying, and I agree with the governor, that foreseeing a lot of these events, no one did. And we are focused now, as we should be, on the potential spillovers on domestic inflation and making sure these things don't persist. But I don't think it would have been possible, without enormous foresight, to have responded to them in time to have any effect on inflation contemporaneously. And furthermore, to have done so would surely have involved a bigger downturn even than the one we're forecasting.
Okay, I've got Faisal and then C.
Thanks, Governor. Faisal Islam, BBC. In the past, your predecessors have, when we've faced with a kind of market shock, maybe sterling falling, have chosen to sort of look through some of that inflation coming up, knowing that it'll wash out of the figures eventually. I just wondered if any consideration had been given to the fact that this is not just a sort of market shock. It's kind of like a conscious geopolitical tactic, arguably, from the Kremlin to push up prices of energy and food, and whether a normal market response is the right response in those circumstances. And a related question would be, just explain simply to somebody at home who's facing £300 a month energy bills why their mortgage costs have to go up.
Yeah, so I think the first question, Faisal, really picks up what Ben was saying a minute or two ago, in that, as he said, there is an established monetary policy response that you do look through the so-called first-round effects, whereas Ben was saying you can see that they are not going to go beyond the horizon of the reaction of monetary policy. And nothing has changed in that respect. I mean, the word transient has become, I know, something of a sort of damaged phrase, but the underlying concept has not changed. So the challenge we have is that this is a very large shock, and we have had to spend a lot of time, going back to what I was saying a few moments ago, assessing what are the likely second round effects of that, that's where we have to sort of concentrate. What are the risks that it will give way to price setting, domestic price setting, domestic wage setting, which will then cause persistent inflation? Now, the evidence of that, there's a lot of things that we've looked at, and by the way, of course, that sort of evidence does emerge with a lag. There are natural lags in the system. But we've seen things, particularly as I set out in my opening remarks, in terms of what we're seeing in terms of price setting, and of course what that implies for the ability to pass on costs of all sorts, which do concern us, frankly, concern us. There's a bit of a sort of two views of the world here. There's a view that you can see from our forecast, which is, as we've been discussing, is it's not a good story. There is an economy at the moment which is still going forward strongly, and by the way, particularly in the labour markets. I mean, I wouldn't emphasise the labour market here. When I talk to firms, I think when we all talk to firms, their concern is still how do we hire enough people, and that they are not hitting the sort of price pressures and price resistance that I'm afraid I think they will hit eventually, but it's not coming yet, and that's the risk of persistence, and that's why we have to act. On the second part of your question, again, very important. And I'd really go back to the question I answered earlier on this and say, if we don't act now, and I realise how difficult this is, I realise, as we were saying, particularly for those on lower incomes, particularly those with higher borrowing costs, but if we don't act, inflation will become more embedded, it will get worse, and we will have to raise interest rates by more, and that, we have to act to stop that.
I have Sue, then Dave Robinson, then Ashley.
Hi, Sue Chan from The Telegraph. Governor, we've had 6 rate rises in a row now. In your opinion, are high street banks passing on those rate rises to savers as much as they have been to borrowers? And if not, does that make your job harder?
So I think the evidence suggests that the pass-through has been faster to borrowers than it has been to savers so far. And you'll have seen, by the way, we publish, of course, monetary statistics, which allow you to look at that. I am conscious that when rates fell to very low levels, I mean, and obviously we're going back now sort of 13, 14 years, there were some issues about the relationship between the official rate and saving rates, which got out of line with some of their sort of previous practices. And we may see some reversal of that going on. But what I would say, and I think this is very important, is that it is of course important that savers receive the returns that they should receive. Now, one of the reasons that we have worked and are working and will continue to work to ensure competition in the banking system is exactly so that sort of thing happens. So it is something that we watch very carefully. It's something other authorities watch very carefully, because there are other responsibilities here too.
If I can just add, we always focus on this in the monetary policy report. We have set out in detail in box D of the report the extent of pass-through, and it is clear that at the moment, as Table 1 there shows, the pass-through, after the kind of pretty unusual period we were in, as Andrew was saying, pass-through onto borrowing rates has been material and in line with the relevant reference rates, whereas pass-through onto saving rates has not been so far. They have started to move up. If you look at instant access deposit accounts, which are the most common, but those have only risen by 30 basis points since November 2021, whereas just before we started raising bank rate, whereas over that period, the relevant reference rate had risen by 115 basis points. So, but one would expect over time some closing, I would imagine, of that.
Would you expect it to be faster?
Well, no, I think from where we are now, it's we can understand where it's at now, but it's something that we will continue to monitor, and it's also something that, just as you're raising, I imagine will continue to be in the public debate, because it is obviously important that savers and savings products are seen to be representative.
Dave Robinson and then Ashley. Thanks.
David Robinson, Market News. You said you take fiscal policy as given for very understandable reasons. The concern of some city economists is, okay, but the market curve assumes further fiscal stimulus. We know the risks of more stimulus are very high, the risks of less stimulus near zero. So that makes it a biased forecast. Market curve is conditioned on more stimulus. How do you stop the problem of this all becoming a little incoherent?
Well, I mean, also I think Ben and Dave may both want to come in. I think it's a form of an issue that we face always. We condition our forecasts on the market curve. Now, there are good reasons for doing that, but we always, as you rightly say, have to recognise and accept that the market curve will embody, of course, all sorts of expectations, some of which are in line with the way in which we construct our forecasts, and some which are not. The market may have views on future fiscal policy and may embody those. We condition the rest of our forecast on what the government has announced it's going to do until such time as the government announces it's going to do something else. And what I would say is that is another reason why the forecast or forecasts and projections as we have today are important inputs to the policy making process. But we spend time, I think, consistent with your line of diagnosis, saying, well, what do we read into this? Where should we sort of aim off a bit, because we imagine there may be something going on, and of course the market curve therefore of course is not, I should stress, our view of what's going to happen in the future. We don't actually create our own curve, but we're not saying the market curve is the view of the future. It's a view of the future which we use. There is a second one, of course, which is again is another one you can take, which is the one we now publish in our MAP survey. But again, that will also have all sorts of assumptions embedded in it as well.
Yes, I mean, it's not the only view of the future, as Andrew says, and when we survey market participants, their predictions are not in line with the market curve either. Presumably they too will have thought about all sorts of possible futures, including different fiscal policy. There have been occasions when, I can think of one in particular, when we were able to identify very clearly something that was affecting market prices but was not in our forecast. And that was on the eve of the EU referendum, when by conditioning assumption, we said there was zero chance of a leave vote. The market was putting some weight on that possibility. And we said, well, here's what the world would look like if the exchange rate were actually in line with our conditioning assumption at zero. And we did a forecast on that basis. So there are occasions when we try and make adjustments. As Andrew says, I think when we're thinking about actual policy, we don't necessarily think rigidly about the central forecast. And as illustrated by the range of scenarios or lots of different forecasts, we think about all sorts of possible futures, and it's the responsibility of each member of the MPC to think how he or she would weight those in coming to a policy decision. But we face this in various forms all the time. I don't think there's a better way of doing the forecast, but it does have this potential inconsistency within it.
And look, I think the key thing here is that we're transparent about the assumptions, and so you can see what the moving parts are. The markets can see what's going on, And as Andrew was emphasising in his opening remarks, we always publish a constant path scenario, and this time we've gone further, in line with those very other possible futures around energy price assumptions or persistence with more alternative projections.
Okay, I've got Ashley, Philip, Escher, and then Bill. We'll definitely get through those if we're quick enough, and then we'll see. Ashley first.
Hi, Ashley Armstrong from The Sun. A few months ago, you used the word apocalyptic to describe the rising food prices. Now it's getting to 13.1% inflation. What word would you use? And then secondly, you asked for people to show restraint when asking for wage increases. Given that most of, or the majority of that inflation is actually coming from Russia's invasion of Ukraine, do you regret telling people that they should be restrained in asking for pay rises?
Well, the food situation was very serious, and of course remains very serious. I go to many international meetings, at G7, G20, and there's no question that when you went to those meetings, there were very great concerns about the situation in world food supply. I mean, the good news is, I think there's several pieces of good news. Actually, food commodity prices have, on balance, come down over the last few months. And unfortunately, the gas prices, of course, more than overwhelmed it going the other way. But food prices have come down. And I think that reflects a number of things. It reflects the fact that actually, there's been some quite good news on potential crop yields in other parts of the world, which will somewhat compensate for the Ukrainian problem. And of course, we've all got, we're all hoping that the ship that left Odessa this week will be the first of many. And that too will, of course, provide much needed relief. We have to watch it very clearly. I mean, food is another element of the inflation story here. We've put a lot of emphasis on energy because it's the big one, but food is another element. On your point about wages, let me make it clear. What I said was that if people pursue very high wage increases, then we will have these second-round effects, and we will get persistent inflation. Let me also say, I mean, the question I was asked didn't include it, but as you'll see from what I said in the opening remarks today, of course, that also includes price increases as well, because you can't obviously take these two apart. And we remain concerned about, as we said earlier, about this question of persistence and the question of the role of domestic price setting and how that could play a part in it. But I want to emphasise this point about high wage increases. It wasn't any wage increase, it was high wage increases. Now, I would note that quite a few other people seem to have made that remark also in the intervening period. I want to finish by just going back to a point I've made quite a few times since then, and I'll make it again because it goes back to an earlier question. Another reason why we have to be concerned about this is precisely the point that rightly has been made by a number of other questions, that it is the least well-off who get hit hardest by this, and it's the least well-off who have the least labour bargaining power, typically. And I would just emphasise that point.
Thanks. I have Philip and then Escher. We'll try and get through as many as we can.
Yeah, we'll try and give shorter answers. And
I didn't want to be the one to say it.
That's a virtue.
Hi, it's Bill Schomburg. Hopefully it should be a short question, a short answer. You say that the MPC is now ready to crack on with gilt sales after the September meeting, but that's going to be subject to economic and market conditions being judged appropriate. Has there been any point this year when those market conditions were not appropriate? Are they appropriate now, for example? When was the last time they were inappropriate? And what are you looking at to judge the appropriateness of the market conditions for selling gilts?
Well, I'll get Dave to answer it. I mean, I'll give you an easy answer to one part of your question, is that on March the 15th, 2020, they were inappropriate. Dave?
Yes, so what you've drawn attention to is one of the three key principles that we've set out in the minutes for that will frame our strategy for asset sales. And the second of those principles is that sales would be conducted so as not to disrupt the functioning of financial markets. And clearly, back in March 2020, financial markets were in such a position that we would not have gone ahead with sales. I mean, we track what is going on in core financial markets, particularly in the gilt market, very carefully, as you would expect us to, and we will continue to do that. But what I think it's really important that we do is not get into some kind of running commentary on where the market has got to. We did, though, say in the minutes, and I think this comes back to the example that Andrew gave, that there would be a high bar for amending the planned reduction in the stock of purchase gilts. We'd need to be seeing. I mean, we use the language in the minutes that say that markets would need to be judged to be very stressed before we considered halting the programme. So, but we also emphasise that the FPC, which we're all also a member of, would have a role in looking at those kind of issues, because after all, it's responsible for the assessment of financial stability, and the FPC was front and centre back in March 2020 when we had very difficult market conditions.
So since March
No,
2020?
I didn't say that. I didn't say that. I just gave you that example, but we track market conditions very carefully.
Can I, Philip, and then Esho?
Philip Hinman from the Observer. I'm still confused, Ben, Andrew, after everything you've said about domestically driven inflation and the effect of interest rates on it. It still seems to be a very small proportion of the inflation that we're going to see. And an awful lot of what comes down over the next 2 years is because those factors start to wane. Nothing to do with domestic inflation. Could you explain what the proportion of domestic inflation is in your rise, and therefore why it's not the case that you're using a sledgehammer to crack a nut?
You're right that it's a minority of the current inflation, and certainly a minority of the peak overshoot. The vast majority of these global prices, and in particular the ones that have been sensitive to the war, but they're not the whole of it. And nor would I describe what we're doing as a sledgehammer. It's true that rates have gone up every meeting. They've now gone up over an 8-month period since we started by more than any similar 8-month horizon the MPC has faced. But I think it would be surprising, it would have been surprising, and we started to discuss the potential for these second round effects, I have to say, a year ago when we were looking even then at what were smaller energy price increases, if there had been none. If it was not the case in this face of what amounts to an enormous hit, external hit to the real incomes of the economy as a whole, certainly the non-North Sea economy, I think it was to be expected that to some degree households would want to protect their real incomes by asking for more pay, and firms would want to protect their real profits by seeking compensatory rises in their own prices. Now, we've seen far less of that, I would argue, because of the monetary regime we have than we did in earlier decades, despite what was a much bigger shock. But we have seen some. So the Governor mentioned some results from our decision-maker panel survey, what we're picking up from the agents. It's been true for some time, I think, that a part of, you can detect in rates of wage growth, a part of the increase in wages that is due not just to the tight labour market, but the fact of these second round effects. And quite understandably, people seeking some compensation because these external hits have been so vast. I wouldn't describe it as what we've done as a sledgehammer. I would describe it as an appropriate response to what we're seeing in that respect, to the signs of more domestic inflation. And I would only emphasize what the Governor said right at the start. It is critical, it is our job to make sure these things don't persist, because we know that high and variable inflation over years, over the medium to longer term, are not good for the economy. And that is why we're having to act. So it is the right thing to do. The last thing I'd say is just to emphasize, in a way, the point you started with, Philip, which is the relative scale of these things. and the huge scale of the energy price hit. We've given various forecasts. In particular, as we normally do, we've given one based on the market profile for interest rates and another based on assuming they stay at what is now today's level. Even had they been at 1.25%, even had they stayed at yesterday's level throughout, my guess is the forecast would still have had a recession in it. So it is in the nature of the shock, it is in the nature of the scale of the shock, unfortunately, that it pushes up inflation enormously for a period and that it depresses activity and incomes. That is unavoidable. And our job is to make sure that we absolutely don't allow this persistence, even though these second round effects are, to a degree, entirely understandable. We have to act to ensure they don't persist.
If you don't mind saying, Philip, I'm just going to observe putting your question and Larry's question together. That because it's in the nature that we have to make forward-looking judgments, and you're saying, well, aren't you sort of taking a sledgehammer to crack something that today looks like a nut, and we're saying, well, it might not be a nut in the future, and we're worried about it. And Larry's saying, well, you were asleep at the wheel in the past. I mean, this is the nature of the judgments we have to make.
Okay, we're going to run 5 minutes over so that we can do...
Yeah, I want everybody to have a chance to ask a question, so we'll...
Escher, and then Delphine, and then Francine, and then we'll see.
Hi, Isha Nelson from the New York Times. Away from energy prices, which obviously you've said many times in the past you can't do anything about, you've noted that there are some aspects of inflation that look to be easing. You said global commodity prices aren't going up anymore, the medium-term inflation expectations are lowering. So how, and because you have this huge recession forecast, was there any pressure to move at 50, to act forcibly, so that you didn't feel out of step with your international peers, where they're moving 50, 75, 1 percentage point to avoid, an impact on the exchange rate, to avoid questions about your credibility, and to have this kind of stronger, more forceful, even though most of this is the short-term energy price increase?
Yeah, no, it's a good question, so thanks. I mean, I've said before, of course, that we don't target the exchange rate. We obviously factor in the impact of the exchange rate into our judgments on future inflation, and that's exactly what we've done this time. I think the point I'd make about comparing, across central banks is that each of us is facing, a different configuration of shocks. I've said before that if you look at the Bank of England, the Federal Reserve and the ECB, we've got elements in common and we've got very different elements to it. And so the fact that I think, say the Federal Reserve is actually, raising by larger amounts, I think you can explain that. I can certainly rationalise that in terms of the different shocks that we're facing. I think that there is more of a domestic demand story in the US than there is here. And so I think that's how I rationalise the different approaches. I think, each of us, because we're independent, we're responding to the economies that we serve, are taking these decisions. And it's natural that those decisions will have elements of commonality, but they will also be different. So I think it's important. When people say, well, you should be doing what this other central bank's doing or that other central bank's doing, my response to that is, we look very carefully at the shocks that we're facing, but we also, of course, look very carefully at the shocks that other central banks are facing. A, to understand how they're responding, but B, of course, in many cases, because we're an open economy, they're affecting our situation as well. But we do serve the domestic inflation. It's domestic inflation that we are targeting.
Thanks. I have Delphine and then Francine. I think that may be it.
Thanks. Delphine from the Financial Times. One more question on the potential for a new Prime Minister to revisit the bank's remit. Liz Truss's team has been speaking of examining the bank's exclusionary independence over interest rates, which sounds like something a bit more fundamental than a change to the target or the mandate. How worrying would that be if it's a question of independence?
Thank you, Delphine. I mean, I'm going to go back to what I said earlier on. It is very important, of course, that as an independent central bank, we do not intervene in an election for the leader of the Conservative Party and the future Prime Minister. So, we're going to stick very rigidly to that. I look forward to working with whoever the new Prime Minister and the new government is, and we will work obviously very constructively. We've got a lot of issues to tackle, as you can tell. So I look forward to that, and I think it's important that we don't, certainly from our point of view, I'm not going to prejudge anything, any conversations we might have. I think Dave set out very well earlier on the history of reviews of the regime. I mentioned earlier, it's important to understand how the regime is constructed, because it was constructed very carefully in 1997 when it was put together. A number of us were involved in that at the time. And it has served, as Dave said, it has served very well. I mean, that average inflation figure is one, again, that is not the case for all central banks. Certainly, I'll say that. But I look forward to working, constructively with whoever the new prime minister is. I'm really not going to go beyond that.
Thanks, then. Francine, last one.
Thank you so much. Governor, can I ask you about the bank's estimate actually on QT? So how much will the QT be in terms of monetary tightening? So let's say you have 80 billion in QT. How much is that in basis points terms?
Dave, do you want to comment on that?
Well, this goes back to some important points that we initially set out last August, actually, and then have subsequently updated, which is that we, the way we think about, and as I responded to an earlier question on, the way we think about QT is rather different in policy terms from the way we thought about QE. We would, as we were saying earlier, we would only be doing, and it is also worth bearing in mind, we're already doing QT because we're not reinvesting maturities. And what we've announced today, which adds up to the 80 billion you quoted, was what we might do in terms of gilt sales on top of not reinvesting. But we're very clear that if you think about some of the episodes when we've done QE, they've clearly been at times, for example, when markets have not been functioning at all well, such as in March 2020. And so one of the channels where clearly QE was operating, QT wouldn't operate in terms of that channel. Equally, often QE was seen as giving a signal about future bank rate. What we're very clear with QE gave that signal. With QT, with quantitative tightening, we've emphasised again today that our first principle is that bank rate is the active policy tool, and QT is happening, if you like, in the background. So that should make clear that overall, we think that QE had very state contingent impacts. You can't sort of conclude that there's somehow some multiplier that you can apply at all times that says what is going to be the effect of QT, and therefore you can't, I'm afraid, do your calculation of some kind of ready reckoner between bank rate and QT. But very much this is going to be happening. Remember, we are confirming whether we're going to go ahead with this in September. So we've just announced our plan today. And we will, if we vote to do it in September, we'll start soon after. But I'm afraid you just can't give an answer to that a question, but I hope that gives you some context as to why we can't answer that question.
This really is the last one. Artie.
Artie from The Times. You'd said in your report that the vast majority of your inflation projections are due to external factors, mainly energy bills, but also energy prices, but also supply chain disruptions. I'm wondering, do you expect these to get worse, supply chain disruptions? And you've also mentioned Brexit. What's the impact of that on these disruptions and on your inflation forecast?
Well, I think we mentioned a few moments ago that there's some evidence emerging that the supply chain story is easing. And the evidence I would draw on for that is the fact that core goods inflation has actually been lower in recent months than we thought it would be. So it's actually lower than we projected in May, certainly I think in February too. And we attribute that to evidence that there is some easing of the supply chain disruption story. Now, of course, there are risks around that. We know that. So obviously, it's a story that has been susceptible to the question of the incidence of COVID, for instance, and COVID particularly in China's situation in that respect. Now, you know, one hopes that's now receding and will stay receded, as it were, but, you know, as we know, that has, you know, come and gone, as it were. So there are obviously risks around that story, but yeah, we are beginning to see that, and we have seen in the last certainly couple of months something of a shift in the makeup of inflation from core into these so-called non-core elements, which is predominantly energy and to some degree food. So that's the evidence that I would use to support that. But I think we do have to watch. You know, we have to watch this very carefully. And then you want to.
Yeah, actually, I'm agreeing with what the government said. We're seeing it in some prices, some easing, in some wholesale commodity markets like metals, for example. The prices have come off quite a lot. Some measures of shipping costs, which was a big part of the story last year, have also come down. And there's actually a chart, I've just found it, 2.6, page 44, which has slightly more direct indicators of supply chain disruption. But as the governor said, I mean, that's true, and funnily enough, it was, you know, sort of in line with what we were expecting a year ago. But all this has since been overwhelmed by the consequences of the war, unfortunately, as far as our inflation rate is concerned, at least for the time being.
Okay, thank you so much, everyone. I do hope you managed to get at least a bit of a break over the summer, and we'll see you next time. Cheers.
Thank you.